Let's bring in Chris Conway, joins us now from Melbourne. And Chris, plenty to talk about. I thought we might actually start with the banks, if that's all right, and your thoughts around, well, how do you figure in potential royal commissions into valuations when it comes to the banks?
Good afternoon, James. Look, I think that's very difficult. It's almost unquantifiable. Not only the whether or not we actually get the Royal Commission, but then, of course, any outcomes that would flow from it. So, look, it's a risk. On the spectrum of big risks and small risks, I wouldn't have thought that it would be something that would prevent people from investing in banks if they thought they were good investment cases.
In particular, if they thought that it wasn't going to impact the dividend longer term?
Yeah, most definitely. Look, obviously, bank dividends have been in question for a while, under some cloud. Most notably, I think ANZ, that was the one that was sort of the lightning rod for whether or not dividends could be sustained. You know, and then you throw into the mix capital adequacy ratios and things of that nature. So, yeah, I mean, it's always under pressure, and we also know that it's an environment at the moment where, you know, bank earnings, the growth simply or most likely isn't going to be there. We're also at the bottom of the bad and doubtful debt cycle. The list goes on and on. So, look, yes, I think there are plenty of reasons why you should be cautious on the banks at the moment, and I think the Royal Commission is just another one of those.
Where does that leave the outlook for the broader index, considering the banks are such a dominant weighting to the index?
It's a very good question, James. I would think if the banks can hold steady, then we might see some pickup of the slack in commodities. You know, we all know about the global growth story that is dominating headlines at the moment. PMI numbers around the globe are at 10-year levels not seen since 10 years. You know, interest rates, yes, we sort of all know that they're coming, but they're not likely to come thick and fast. So there's probably not too much to derail that global growth story. And as I said, if banks can just hold firm and we get some growth out of commodities, and of course our market in particular being so heavily weighted towards commodities, then there's no reason I don't think that we can't push higher.
It's good news because, I mean, we looked pretty comfortable once we remained and pushed higher from 6,000, obviously coming back a fair bit to 59.50. Your thoughts on where to from here? Are we likely to kick back in the near term to 6,000?
Look, I would hope so. Just to put it in a bit of perspective, James, you know, I think we all do it. Myself, analysts, journalists, we all jump a little bit at things that we probably don't need to jump at. Let's not forget that in the space of about a month, the market rallied 400 points. And people were sort of falling all over themselves to buy the market. We've given back 100 points, and now everyone thinks it's crashing back down to 5,500. So somewhere in the middle there will be the reality. And I would have thought, and I would hope to see the bulls sort of defend that 59.50, 59.25 level that you were just talking about, because it was a previous swing high and sort of multi-year high from earlier in the year. So hopefully they provide some support here. You know, we are moving into a seasonally strong period for US equities and, you know, sort of really Australian equities as well. It's called the Christmas rally or the Santa Claus rally. It tends to actually come, at least from my experience in the last couple of years, more likely in January. And the reason why I know that so firmly is because it's usually when I take a break and I'm not around to actually take advantage of some of the moves that we see, which is particularly frustrating. So it might be a post-Christmas and even post-New Year rally.
And what do you think are likely to be the main contributors to it? So much is made in terms of some of the offshore moves, in particular out of the US and the ongoing sort of debate that is US tax reform.
Yeah, the tax reform is another one of those ones sort of that I was talking about before where, you know, we all jump on it and jump to it, and any little headline that comes out and, you know, we seem to think it's the thing that's shifting markets. I would not hesitate to admit that tax reform and potential tax reform was the spark that lit the fire post-Trump being elected. But I think that fire now burns independently, and it's because of those things I was talking about before. Global growth picking up, a much stronger and continually improving US economy. As I was saying, the fact that, you know, we know interest rate rises are coming, but, you know, central bankers around the world will be very reluctant to derail the growth story that we have. So I think we can hazard a guess pretty safely that they'll come slowly and they'll be telegraphed pretty well. So, you know, specious reasoning though it may be, I think it's the absence of anything particularly bad that allows our market to continue to rally. And like I said, I just don't think tax reform carries the weight that sometimes the headlines suggest that it does. I certainly don't expect anything this side of Christmas. And I'd be really surprised if, people who closely analyse, the potential for tax reform do expect anything really serious this side of Christmas and the new year for that matter.
Can we get stock specific? A bit of corporate news around at the moment. Baby Bunting under a lot of pressure. The last check was down around 8%. No big surprise considering the downgrade to profit. Your thoughts though on the reaction? This has been sold down pretty heavily in recent times. Opportunity, or would you be a little bit cautious around these guys?
A bit of a play on words here, James. Whoever is your editor wrote a nice line for you earlier about investors spitting the dummy with regard to Baby Bunting. The question I posit is, do you throw the baby out with the bathwater? I would think possibly not. There's some transitory factors that are at play here. We all know about some of their competitors shutting down and the volume of stock that hit the market and the heavy discounting that ensued, which hurt their margins, of course. And the other factor being that they couldn't get hold of a particular car seat that is hugely popular. The other little element here, just allow me just a bit of slack, James, to tell a bit of a story. So I like to think of myself as someone who's financially responsible. And when my wife and I had our little baby boy, I was on Gumtree looking for second-hand strollers, trying to save a bit of cash. She would posit that I'm actually just a tight ass and she wanted to buy the brand new one that didn't have any other baby spit or anything else on it. No points for guessing who won that argument. So I think there's something to be said for, consistent demand there. It is, for a lot of parents, a first-time item or a particularly important item when they go to Baby Bunting. So I think that demand will be sustained. And I think, as I said, once these transitory factors pass, they can get back to doing business and they'll be stronger for it because they'll have less competitors in the space.
It just seems that if you're a retailer, if you're in that consumer discretionary space at the moment, any false step and you just get savaged because there's so much negativity around the broader space, be it through Amazon, retail sales, consumer confidence, take your pick. Are there going to be winners out of it? Do you think? Are there opportunities as it stands, putting Baby Bunting aside, within that retail space that you would urge people to take a bit of a look at?
Yeah, look, one that we hold is Kathmandu, and that's just because it's a company that has continued to grow, continues to do things particularly well, has paid down debt. It just seems everything that they've done over the past 12, 18, 24 months has put them in a really good position. Like-for-like sales up 5.5% over the last financial year. So, there's one that's doing really well. Obviously, it's clearly a specialist retailer. But I think just more broadly, there's some consolidation that needs to go on in the sector. So we all know the problems with Myer. Even a good name like Premier Investments of late had some not too flashy results, or not results that weren't up to what the market was expecting. So I absolutely agree with the premise that the entire sector is under pressure, and it's largely because of Amazon, whether or not they turn out to be the thing that everyone expects or not. But I think some consolidation has to happen there. But yes, absolutely there will be winners. And I would think it's still your specialist retailers. I think it's your JB Hi-Fis. I think it's your Kathmandus. I think it's your Burson Auto Parts. I think it's, Collins Food Group. So there are names there that I think will survive and then will prosper out the other side.
Look, you could sort of almost throw this next one into the lot there, but slightly different. A lot of enthusiasm over China-facing stocks at the moment, and A2 Milk is the one that's certainly been stealing a lot of headlines. I think the Australian-New Zealand boss saying they're the fastest growing brand in terms of that milk brand, that milk segment over in China. It's run hot, though. Look, it's, you look for growth, and it's at the top of a lot of people's lists. Your thoughts around A2 Milk ahead of course, the AGM tomorrow?
Indeed, the AGM tomorrow, and indeed those comments in the Australian from their Asia-Pacific Chief Executive today, talking about growth rates of above 4%. I think it was 4.1% to hit the number on the head. James, for me, this is one where I need to take off my investor hat and put on my trader hat, and that's what I've done. Because, yes, I think the consensus valuation out there is somewhere in the order of $6.50. We know it's well beyond that. I mean, it's peeled back a little bit today towards $7. But it's the momentum in this one. And as a trader, I'm willing to take the risk that that momentum will continue long enough for me to benefit. and then I can move to the sidelines and with my profits. Now, of course, that could all come asunder tomorrow if they miss in any way, shape or form on any of the metrics that the market is interested in knowing about. So yes, there's an element of risk there. That's the same with any growth stock, and particularly any growth stock that has risen as sharply as an A2 milk. But for the moment, I'm willing to carry the risk. Ask me at 3.50 tomorrow and I might tell you a different story.
Okay. Chris Conway, got to leave it there. Great to talk. Thank you.
Thank you, James. Cheers.
Chris Conway there from the Australian Stock Report.